The thing that SBA does for you is that it helps you afford sort of more transaction than you otherwise could with a conventional loan because it's highly leveraged. It's meant to be a high leverage vehicle. So here's some of the things to think about. You get a 10-year term, fully amortizing, no balloons, and the SBA requires a minimum of 10% down. So typically, just from an industry standard perspective, the cap stack looks like 10 to 15% down from the borrower. And that could include some amount of investor contribution, kind of bridging the gap between what the borrower might have, operator, guarantor might have, and sort of that deal size. 10 to 15% down, then generally a 10 to 15% seller note. That's been sort of industry standard for years. And then the SBA lender is typically doing 75 to 80% financing. So if the client is putting 10% down in, you're technically getting 90% financing between the SBA loan and the seller note. And to some people tuning into your podcast, that might sound absolutely crazy that you're getting 90% financing to acquire a company. Again, the SBA is kind of compelling lenders to maybe make cash flow loans because also there's not a collateral loan to value goal here. If our guarantor operator has collateral or has equity in their home, we will take a lien on the home, but we're not necessarily looking for a certain loan to value. It's all cash flow coverage based. And at 90% financing, the 10-year term is the thing that's helping you kind of make all that work.